computer. So here we are, ladies and gentlemen, we are doing this question that was tested in December 2022. December 2022 was the easiest paper ever. Most of the students who failed in this sitting never knew how to manage their time in the exam very well. As usual, as I always tell them, the moment you get, like you're taking more than an hour to do a question, however good that question looks like, if you're taking like 1.5 hours, 1 hour, 10 minutes, you will repeat that paper come next semester. AFR is more of time management than even knowledge. If you really know how to manage your time and you get to do your questions as much as you can within 40 minutes, one question should take about 40 minutes, you will be able to pass, because AFR is all about entries. I have as many entries that are correct as possible, and you shall see places. And I would want to start with the group consolidation question, which was question number 3. Question number 3 of last sitting. Question number 3. This kind of a question, ladies and gentlemen, always this kind of a question, ladies and gentlemen, start by reading the requirement. So question number 3 here, allow me to increase the font size. So question number 3, we are told, H Limited, a public limited entity, operates in the information technology sector. It has made several investments in other companies within the industry, which has earned it a market leadership role in the sector. The following draft financial statements for the year ended 31st October 2022 relate to H Limited and its investment companies. So statement of profit or loss and other comprehensive income for the year ended 31st October 2022 is here. So we have the profit for the year is 2015 for the parent. Then we have 165, 865. So you can see OCI, other comprehensive incomes. Of course, here we take the revaluations. So you can see it is only the parent that did some revaluation. It's only the parent whose revaluation has been booked here as 70 under OCI. Then, of course, we have the income for the year plus other comprehensive incomes, giving us what we call TCI, the total comprehensive income. Then we have a SOFP for H, for S, and for L. So, and this kind of question, don't go to the additional information. First of all, get to understand what is being required of you. So A, they want me to give them the consolidated statement of P and L and OCI for H group for the year ended 31st October 2022. B, consolidated statement of financial position for H group as at 31st October 2022. So this is an examiner who is wishing me success. Actually, is an examiner who wished students a Merry Christmas, a Merry Christmas, a Merry Christmas by giving these students quite an easy question. So then where should I get started in this kind of a question? Where should I get started in this kind of a question? So with this kind of a question, the first thing that I will do, as I've taught you severally, that format is very, very important. So what I'll do, I'll come and understand my group structure. So I have here the group structure. So this is the first thing that we shall do. So group structure, you're right. So understand the group structure here. Group structure. So under this group structure, we have a company called H that has bought some interest in a company, known as who we are told here, H Limited acquired 80% ordinary shareholding in S Limited. So H acquired 80%. Acquired 80% of S, like that. All right. So in this case here, of course, this H will become a parent automatically because 80% is a controlling. These people are controlling. So automatically H is the controller. And then, of course, we have a non-controlling party, a non-controlling interest will be owning what percentage? 20%, 20%, 20%. Then what I'll be interested in, especially for this is the date of acquisition. DOA is very important, and the date of the financial statements. date of acquisition and the date of financial statements for me to be able to know this S-Fine was a subsidiary, but a subsidiary in our books for how many months? A subsidiary in our books for how many years? Very important, DOA and DOF, date of acquisition and date of financial statements. So in this case here, we did acquire this acquisition. This acquisition, we are told, H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019 is when we acquired S. So it is 1st of November 2019. How about the financial statements given in this question? What date do they have on them? The financial statements given on this question, it is statement of financial position as at 31st October 2022. So we have here 31st October 2022. So 31st October 2022. Is there somebody who can, of course, here we can't count months. Here we can only count what year somebody years. Because you see, we have a 2019. We have a 2020. Right? Is there somebody who can count for us very well here? Count for us very well. How many years do we have? How many years do we have? How many years do we have? Somebody should be able to count for us very well. Tell us between this date of acquisition and the date of the financial statements, how many years do we have? Of course, I can see from here, the next year will be talk of 1st of November 2020. Then we have here 1st of November 2021. 2021. Are they counting in this case here their years very well? Are they counting their years very well? From there, ladies and gentlemen, if I adjust my camera a little bit, from there, if I adjust my camera a little bit, if I adjust my camera a little bit, if I adjust my camera a little bit for the board to be seen in full here, yes, like that, yes. After this, ladies and gentlemen, we have another year going all the way to 1st of November, now 2022, which is, here. 1st of November is the same as 31st October 2022. So then if I count my years, ladies and gentlemen, from this date to this end here, from this day to this end here, this will be year 1, year 2, and then we have got how many years? 3 years. So meaning that S was our subsidiary in this group structure for a cool how many years? A cool 3 years. For a cool 3 years. That is very important to me. Now, ladies and gentlemen, from there, we go to the next acquisition, the next investment that these people were able to make. The next investment that these guys were able to make is note number 2. M Limited is the main competitor of H Limited. And on 1st May 2022, M Limited and H Limited each acquired 50% of the 200 million ordinary shares of shillings 10 each in L Limited. So, ladies and gentlemen, this examiner was a bright examiner, and I like such kind of examiners who would want to put some students, in this case, who are not serious, under the bus. So he wanted to bring this thing of joint arrangements. He wanted to confuse students with this concept of joint operations, that we have M and we have H Limited, who came together, and each of them was able to acquire a half. Mr. 50%, they acquired 50% of L. So H took 50% and M took 50%. So you see, so many students went ahead and treated this question as a joint operation. Then they started, ladies and gentlemen, taking 50% of the assets, 50% of the liabilities of L to the group structure. That was the biggest mistake that those students did. This examiner was a nice examiner. Remember, when I introduced group consolidation, I told you, yes, having shares, please listen. We have this normal number where we say that, if you remember here, that if shares are more than 50%, if shares in a company, if you own more than 50% of the shares of a company, then this automatically becomes your subsidiary. This becomes automatically your subsidiary. If you have exactly 50%, this could be exactly 50%. This could easily be a joint arrangement. a joint arrangement. You can easily call it a joint venture or a joint operation. Shall come back to that. Exactly 50%. 50%. And then we have 20% all the way to 49.999%. These automatically will be called what here? An associate. An associate. An associate. So these one here, call it a joint arrangement. A joint arrangement. A joint arrangement. A joint arrangement. So between 20 and the 49.99999, that would be called an associate. And then, of course, we have here, lastly, we have less than what here? Less than 20%. Less than 20%. So this becomes your mere investment. Mere investment, what some literature will call a financial instrument. What some literature will call a financial instrument. What some literature will call here a financial what here? Instrument. Now listen, this is how we look at this thing quantitatively. But I gave you a very good example. If I remember that morning when we started this group consolidation concepts, discussions, early morning classes, the 4:30 a.m. classes, if I remember, we said, for example, if the 26 of us here were to come together, we are all of us accountants. If we come together and each one of us contributes $1 billion, of course, we are going to be very rich. If each one of us was to contribute $1 billion, then we shall have a fund of 26 billion. And if we have a fund of 26 billion, a fund of 26 billion, listen, what we could easily do is to go to Nairobi Hostel, stock exchange, assuming Nairobi Hostel is listed at the stock exchange, and buy even all the shares. So when we buy all the shares, what will happen at management level? We are accountants, as much as would have to put in a lot of efficiencies, a lot of effectiveness in terms of running the hospital. There is no way we shall be able to run this hospital because we really need more doctors at the board level than accountants. Because we know the primary function of a hospital, right? We know. So then what that would mean? What that would mean is that even if we have bought stock over 80% of Nairobi Hospital, it means that these 20% shares, we shall be able to get like another investor, right? These 20% now could be held by who? By doctors. And once you have these 20% being held by doctors, and we go ahead to relinquish our controlling aspect at the board level, we go ahead and tell these guys, you know what? For sure, we came to an industry that we do not understand. We would want you guys to be the controllers, sit at the board level, make decisions here on our behalf. So in this case here, basically, we are relinquishing our right of managing this company to this person who has got a smaller interest. And we said, qualitatively, according to IFRS 10, which talks about consolidation, that nowadays is no longer about who has the biggest shareholding. Nowadays, it's about contractual arrangements. If we have a contract with these doctors, ladies and gentlemen, who only have 20%, and we have allowed them to run the business on our behalf, then we shall be considered to be minority. We shall be considered to be non-controlling, our shareholding notwithstanding. So the thing is, who is controlling, who is able to throw the shots here, who is able to call the shots, especially at the board meeting. So regardless of your percentages, if your examiner comes and talks of something, if your examiner comes and tells you, hey, these people, fine, they own 50-50, but one party has given the other party the right to run the business. The one who has the right to run the business is the controlling partner, and the controlling partners must consolidate. A controlling partner must consolidate, so a controlling partner will always be taken to be like the owner, the parent of this particular what here? Investment. So that particular investment will be called a subsidiary, regardless of even the percentage can be 30%. I can be owning 30%. But the moment I've been given by the other shareholders the right to run this business, even if I own 30%, then automatically I'm the controller. And if I'm the controller, then this is my sub. You know, sub comes from part of sub. Then this automatically becomes my subsidiary. This automatically becomes my subsidiary. Now listen, and this is where students went wrong. because we saw students who are running this question as if it's a joint arrangement. We are told here, M Limited is the main competitor of H Limited. And on 1st May 2022, M Limited and H Limited each acquired 50% of the 200 million ordinary shares of shillings 10 each in L Limited. So ideally, this should have been what here? A joint arrangement. The consideration paid by L Limited consisted of cash of shillings 15 per share and also a 1-for-2 share exchange when the consideration paid by H Limited consisted of each of cash of shillings 15 per share and also a 1-for-2 exchange when the market price of H Limited share was 20 each. M Limited also paid blah, 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 blah. But now we are told here, the ordinary shares of L Limited have 1 voting right each. That is purely noise. They want to confuse you. We are told upon the acquisition, H Limited had a contractual right to appoint majority of the board members. To appoint 60% is majority. Yes, we own 50%, but we have a contractual arrangement with our co-owner to appoint more board members to L. Let me read this again. I mean, this is very interesting to me. This is the most interesting thing to me this afternoon. We are told upon the acquisition, H Limited had a contractual right to appoint 60% is majority of the board of L Limited, with the remaining 40% appointed by M Limited. M Limited and H Limited each appointed 1 member to L Limited's senior management team. It doesn't matter. The board really is the one that has a say here. It is the senior manager appointed by H Limited who makes the key. Look at this. The senior manager appointed by H Limited again, who makes the key decisions regarding the development of L Limited's new technologies, its principal revenue stream, the market it will operate in, and how it is financed. The fair values of L Limited's net assets approximated their carrying values at the date. Ladies and gentlemen, I'm learning something very important here. I'm learning something very important here. That H went ahead in this case here and acquired 50% of L. But they're giving us a very important piece of information there that tells us that, hey, this 50%, there is more than meets the eye. You can't tell us that L is just in the joint arrangement. You can't tell us because of this messed up 50%, exactly 50%. You can't tell us that L is basically like our joint venture. No. No. There is more than meets the eye. We are told, fine, we own 50%, but we have the right, a contract with the other co-owners to do much more, to take more to the board, to appoint key management staff who are able to take more decision-making responsibilities than the other guys who have been brought in by the other co-owner. So straight away, a good student was able to pick here that L is also a subsidiary. It's not a joint arrangement. It's not a joint arrangement. So first of all, are we together really up to here? Are we together really up to here? If I adjust my board a little bit, I would want students to see here. First of all, are we together up to here really? Are we together? Great. Is there any student who confused this and brought in the issue of joint arrangements in an exam? Please be very honest with me. Anybody who did this exam last semester and they did confuse and they treated L as a joint arrangement? At least I can see one student there who is very forthright, who is telling us, great, that is where you went wrong. And if you missed, of course, this small element, then you never had the right income statement. You never had the correct balance sheet consolidated. So you lost all those marks. You lost all those marks, yes. You lost all those marks, and yet this was a straightforward question. I'm so sorry for that. The good thing is that the future is already here with us. The future is 2 months or 1.5 months? We shall be able to show this examiner dust. So then, ladies and gentlemen, this is our subsidiary. And if it's our subsidiary, then I'm interested in the door and the DOF. I'm interested in the door and the DOF. I'm interested in the door and the DOF. Are you able to see the door? Are you able to see the DOF? Are you able to see the door? Are you able to see the DOF here? Are you able to see the DOA? Are you able to see the DOF? DOA stands for date of acquisition. Date of acquisition. DOA stands for date of acquisition. So is there somebody for L who can see the DOA there? The date when this was acquired. The date when this was acquired, we are told. The date when this was acquired, we are told. The date when this was acquired, we are told. Here, M Limited is the main competitor. 1st May 2022 is when we acquired 50%. 1st May 2022 is when we acquired 1st of May. So we have here 1st of May 2022. So we have here 1st of May 2022. How about the date of the financial statements, our famous DOF? The date of the financial statements, the date of the financial statements, the date of the financial statements, ladies and gentlemen, the date of the financial statements, they're here. 31st October 2022, 31st October 2022, 31st October, 31st October, 31st October 2022, sorry there. So then we should be able to count the months. So in this case, I would want the gentlemen who are around here to count the months for me, because I don't trust any lady with the counting dates. Only men to count for us, only men to count for us. We should never, ever trust any lady to count dates for us, only men to count. Because if a lady tries counting, you'll see they give us the wrong. Let's also give them a chance. Let's give them a chance of counting, but it will tell me they can never be accurate. 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 6 months, right? Let's count together. So you see, May is being counted because you began from the beginning. So we have the month of May, June, July, August, September, October, the whole of October, the whole of October, the whole of October, the whole of October. So these are 6 months. These are 6 months. These are 6 months. I can see Jacqueline is a legend. Great. 6 months, 6 months. The whole of October has to be counted. So then this L was our subsidiary for 6 months. So now we are dealing with a question that has a parent who happens to be having how many subsidiaries? 2 subsidiaries, 2 of them. So then what we're going to do procedurally, you give us the net assets of each of these subsidiaries. You give us net assets. So we start with net assets of S, this one here. So anza na ya kwanza, so net assets, because you must understand the assets of your subsidiary. So net assets of the subsidiaries, net assets of the subsidiaries at acquisition and at reporting. At acquisition and at reporting. So remember, when we talk of net assets, ladies and gentlemen, net assets, we are looking at the equity components. Equity components. So equity components, what do we have here as our equity? I know now you guys have gotten used to this. Equity components, we have the ordinary share capital. The ordinary share capital, we have here share premium. After share premium, we have retained earnings. Retained earnings. After retained earnings, we have fair value adjustment. Fair value adjustment. After fair value adjustment, of course, now we must get used to this, because now we are building up a very good case. We are now moving up slowly by slowly. So after this fair value adjustment, of course, we must have what we call depreciation of the fair value adjustment. And then the last one will be the unrealized profit on stock, whenever we have an upward stream. If we have an upward stream, UPS will come here. If we have like this question, we had an upward stream, a stream moving up when the subsidiary sells to the parent. When a subsidiary, this is an upward stream, subsidiary selling to the parent. If it's downward, UPS will not appear. So please, once you finish writing these things up to here, could you kindly put a thumbs up? Kindly put a thumbs up. Kindly put a thumbs up. So we continue, ladies and gentlemen, here. Now we are populating this. Remember, we are looking at the net assets of the parent, not parent, but of S Limited. S of the subsidiary, the first subsidiary, please name it. Name this is subsidiary S. So subsidiary S, I'm looking at this statement of financial position, S. Are you able to see in this case here the equity of S? Yes, I can see S limited, 1,500, 500. So we can see in this case here, 1,500. We have 500, and then we can see retained earnings for S is 2070. Retained earnings for S is 2070. Retained earnings for S is 2070. And if you are keen, look at where I'm putting these. Look at where I'm putting these figures. I'm putting them under at the reporting, because I'm reading financial reports at reporting. All right. So one thing that I know, share capital does not change. Share capital here will be the same. At acquisition and at reporting, share capital the same. Abracadabra. Share premium doesn't change. What will change always is the retained earnings. So you must search for retained earnings at this particular point where they tell you the subsidiary was being acquired. That will change. That will change. So then come, ladies and gentlemen, here, and look for retained earnings. Look for retained earnings of S at acquisition. It told us here, H Limited acquired an 80% ordinary shareholding in S Limited on 1st November 2019, when the retained earnings of S stood at 340. When it stood at 340. So retained earnings at acquisition here is 340. Now from there, ladies and gentlemen, I will be looking for these other things like when the subsidiary was being acquired, we must bring in a valuer. So then this valuer will be able to advise and tell us whether our assets should be taken up value-wise or not, or otherwise. So let's look at whether there was any revaluation. Revaluation nowadays, technically we call them fair value adjustment. We normally call them fair value adjustment. Great. Let's read here. Let's read this together. So we are told here, the fair value of the identifiable net assets of the S Limited at acquisition were worth 2440. So they're telling us that the total net assets, they're telling us something very important here, that the total net assets, we call them total NA. The total net assets were 2440. Remember, this depreciation does not occur here. The UPS upward stream does not happen here. UPS upward stream is zero here at acquisition. Is zero here. You can even decide to draw an emoji for this examiner instead of writing zero. You have the emoji smiling like that, right? So you're saying that the total net assets is 2440. So you can easily get to know what the fair value adjustment is. The fair value adjustment now will be the balancing figure. The revaluation amount will be the balancing figure. If I were you, I would take my calculator, punch 2440 minus 340 minus 500 minus 1500, and then I'll be able to get this fair value adjustment. The most important thing is to know that at acquisition, there is nothing that has depreciated. At acquisition, UPS does not appear anywhere there. Let us be consistent and maybe put dashes. Please don't draw emojis. Don't draw emojis for your examiner. Dash there. So most of them are telling me that this fair value adjustment is what here is 100. Is 100. The fair value adjustment is 100. The fair value adjustment is 100. The fair value adjustment is 100. Now listen, let's read this. Let's read this very well. We are told here, the fair values of the identifiable net assets of the S Limited at acquisition were worth 2440. The excess of the fair values over the carrying value was due to an unrecognized brand whose remaining economic useful life at the date of acquisition was 5 years. So they're telling us, ladies and gentlemen, in this case here that we have some brand that was not recognized. So this 100 here is a brand. This 100 here is a brand, could be a trademark like RCM, online college, right? Is a brand that we would want to now put in our books. But the most interesting thing that most of my students were not able to pick is the concept that they gave us a span of this brand. They told us that this brand is a 5-year brand. So then we ought to have amortized. We don't call the loss of value of brand as depreciation. We call it amort. So you amortize this. So then this 100 should be what I'll call in brackets here depreciated or amortized. So then, oh yeah, what I will do when I'm calculating my amortization figure, I know it's straight line always. So I know I will take, in this case here, amortization or depreciation, you can call it that, but not proper. Amortization per annum. This will be 100 divided by 5 years, which gives me 20. But remember, as at the end of the current financial reporting date, you guys told me that 3 years have lapsed. Between DOA and the DOF, are you able to remember? Between DOA and the DOF, we have got how many years there? 3 years. Between DOA and DOF, between date of acquisition and date of financial statements of this subsidiary S, we had 3 years. Remember, here we normally take the accumulated depreciation or the accumulated amortization. So for 3 years, then we'll talk of 20 times 3, which gives me 60. So this 60 is what I shall come and put here. But please remember to call it what here? Amortization. Amortization of the fair value, which is what here? A brand. So I'll take it by the end of the 3rd year. I saw students who are doing this very nicely, but unfortunately, the devil took, in this case here, a toll on them, and they ended up putting just 20 there. Normally, we take cumulative, accumulated over the years. This brand is losing 20 per year. So in 3 years' time, it would have lost what year? 60. It would have lost 60. In 3 years, it would have lost 60. Great. I'm so sure once we do another question of this nature, one more time, you guys will become experts. Especially those students who have been waking up. I'm so sure you guys are able to see really a lot of value in these classes. If you've been waking up at 4:30, whenever we have advanced financial reporting, I'm so sure you are making huge progress. You may not understand it, but by the time we'll be finishing this syllabus, and of course, you guys will be going to exams in April, things will not be the same. So if we have got any student in this case here whose head becomes very heavy whenever they hear the alarm, and that is the time they would even want to go for a second blanket, please, that is not our portion, because there is quite a lot we are learning in the morning. And I would want us to become group consolidation experts. I would want most of you to be in these particular tables, where issues to do with mergers and acquisitions are being discussed. So don't just wait for the end of the semester and then you come and cram, and then you pass. No. It's more than that. So in the amortization per annum, please recap, no problem. So remember, how do we do our normal depreciation? If you buy an asset worth 1,000, and then you are told that this asset has a useful life of 10 years, no scrap value. How do you get depreciation? You take the purchase cost, 1,000, minus 0, which is the scrap value, over the number of years, which is 10. So if you do it that way, then you will be able to get the depreciation per annum. The same case in this question, they have told us that this brand, which is now an asset, has an economic life of how many years? 5 years. So meaning that this 100 has to be spread out to the 5 years. So each year then we are losing how much? And the loss is called amortization. So each year it will be 100 divided by what year? 5, which will be 20. But you see, by the time we are writing these financial reports of this year, we discovered that how many years have lapsed? If you counted very well, 3 years. So that the total value lost, the total amortization will be 60. So 60 is what we bring here. Now from there, we ask ourselves whether these two businesses, S and H, did some internal sales. If they did some internal sales, then we have to watch and see whether it's an upward. Whether it's an upward, upward stream. Let's see here. So we are told here in note number 3, note number 4, during the year ended 31st October 2022, S Limited is the one that went upstream and sold goods worth 400 million to H. So this is an upward or upstream transaction where a subsidiary sells goods, in this case here, to this mighty holding company. So this is an upstream. This is an upstream transaction. So if it's an upstream transaction, then UPS must come to the net assets here. But now the question is, then how do we calculate UPS? 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 So to get UPS, ladies and gentlemen, here, this is the formula that we shall be using always. To get UPS, you always take the profit margin times risk. The profit margin times remaining intra-sales. Risk is remaining intra-sales. Remaining internal sales. You see, if S sells goods to H, and H is able to sell all of those goods to third parties, then the group realizes that profit. But if S takes some goods to H sells part of them, like a half of them, and then we have a half remaining in that stock of the group, of the parent, then there is a problem. Because you see, S has done its income statement, and its income statement, it must have gotten a profit out of this goods it sold to H. It is already booking, it has already booked a profit. But you see, this profit is still within the group, And if it's profit that is well within the group, then it is not realized. It is still unrealized. This is as good as having taken goods from just one department to another department within the company. Because you see, H and the S, they're one economic entity. So anytime we are calculating unrealized profit on stocks, we always use remaining internal sales. Remaining internal sales. Remember, the total internal sales here was 400 million. That is the total that was sold, that was transacted within the group. But you see, some of these had been sold to third parties. And whenever they're sold to third parties, then we realize that profit. All right. So let's get the policy properly here. So ladies and gentlemen, what have they told us here? What they've told us here is that H, during the year 31st October 2022, S Limited sold goods worth 400 to H Limited. S Limited reports a gross profit margin of 25. Great. This examiner was a nice examiner. He gave us profit margin directly. So he gave us profit margin directly. And the profit margin is 25%. The profit margin is 25%. The profit margin is 25%. If I was the one setting this paper, I would have given you markup. Because I'm a bad examiner. Because I'm a sadist. No, I'm joking. I'm the best person on earth. The best person on earth. I would have honestly given you profit margin. Yes, I would have given you profit margin. Even if you look at my face very well, I don't look like a person who can even hurt a SSFly. If I see a SSFly passing, I'll just leave it like that. So it is 25% profit margin. I'm not going to make any changes there. I'll not recalculate, because if it was a profit markup, then I would have recalculated. So 25% times the remaining. You see, in total, the goods transacted in the group were 400 million. 400 million. So 400 million. So in this case, I'm interested in the remaining. What have they told us about the remaining? So I repeat again. S Limited reports a gross profit margin of 25% on all of its sales. 20% of these goods remained in the closing inventory of H. So 20% is what the fraction that is remaining. So times 20%. So times 20%, times 20%, times 20%, times 20%. So is there somebody who has got quite a good calculator which they can use to give us this figure really? So Willie Velma, very active. She's giving me a figure of 20. A figure of 20. A figure of 20. Thank you, Lucy. Thank you. So this 20 is going to be charged here, 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 here. And because it's unrealized, basically it means that the stock of this company is overstated. Because the IAS2 tells us that the stocks can only be maintained at cost, or net realizable value at cost in this case. Don't put profits there. That is against prudence. How do you put a profit in your stock? So if there is a profit there which is unrealized, that has to be subtracted. That is overstating our net assets. But now remember, I don't know, maybe I should give you a minute. You tell me, when should we bring UPS in our net assets account? Is there somebody who can tell us? When should we bring UPS? When should we bring UPS in our net assets account? Because the moment you get it wrong there, I'll be able to teach you again next term. Next term, for sure, I would also want to teach you. Next term, I would want to teach you, and that is why I'm working so hard to teach you, but not AFR. I would want to teach you in BDA. In BDA. I would want to teach you guys in BDA. BDA. Business Data Analytics paper, the final paper, the exit paper, as you become members of ISPAC. Not AFR, not AFM. Jacqueline, I don't understand why you are saying 16. I asked you, can somebody in this case here tell me, just in your own language, and if possible, right there, either even in Kiswahili or even in your mother tongue. Fortunately, I'm so much privileged to know most of the tribes, right, in Kenya. I don't think there is any tribe that guys can really use which I can't understand, right? When do we bring UPS to the net assets account? They're not talking to me now. They're not talking to me now. They're not talking to me now. We bring when there is upward streaming, when the subsidiary sells to the company, to the holding company. When the subsidiary sells to the holding company. I will come and write it here. If I'm the one, I'll just write here UPS upward. And then, of course, if I get a situation where they're telling me that it is the holding which sold to H, if it's the holding that sold to S, I mean, that's downstream. You know, downstream, it just passes like that. You can't really capture that in the net assets. Downstream, you don't capture that in the net assets. When it's upstream, when we are selling to the parent company from subsidiary. Thank you very much. You guys are geniuses. You guys are geniuses. You guys are geniuses. Then could you kindly give me these figures now here? At acquisition, already I have the figure. Is there somebody who can give me this at reporting now? At reporting. Is there somebody who can give me this at reporting? Is there somebody who can give me this figure at reporting? At reporting, at reporting, at reporting, what do we have? At reporting, what do we have? At reporting, what do we have? At reporting, you take this, minus this, minus this. So I'm being given by Sharon Kendi 3990, 3990, 3990, 3990. Sharon also really has confirmed this. Now, I would want to see whether my students are able to follow what I'm teaching them. Who can remind us, whenever we talk of a difference between these two, when you subtract these two, you normally get a very important difference. What is the name given to the difference between the net assets at reporting and the net assets at acquisition? There is a very important PAP. Thank you very much, Catherine. PAP, yes, it's called PAP. So go ahead and give us the PAP. Give us the PAP. So the PAP is post-acquisition profit. Post-acquisition profit, post-acquisition profit, you are subtracting. 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 You are subtracting. Post-acquisition profit, you are subtracting. Okay, so they're giving me a figure of 1550. Post-acquisition profit is 1550. Later on, we shall be subdividing this. We shall be subdividing this to the owners. But today we don't want to do that. So then I would want us, ladies and gentlemen, to go straight away to the goodwill of S. Let's finish with goodwill of S. Let's finish with goodwill of S. Let's finish with goodwill of S. So go ahead and give us the goodwill of S. Goodwill of S. So go ahead and give us the goodwill of S. Goodwill of S. So how do we get goodwill of S? Full method. We are using the full method. We are using the full method. We are using the full method. So full method calls us to bring the consideration of the parent here, the parent. So the parent, to acquire the parent, to acquire the subsidiary, the parent in this case here paid how much? I can easily pick this. In this balance sheet given, I can see the investment in S. The parent paid 1830. Is it 1830? The investment in S, the parent paid 1830. Investment in S, the parent paid 1830. Consideration paid by the parent is 1830. And also you can also get these figures, and gentlemen, if you come, they're saying it's 15. No, that's a different figure. If you come here, they'll also tell you here. You can see here, H Limited acquired an 80% ordinary shareholding in S Limited of Fasto, like that. The fair values of the identifiable net assets were like that. The excess, let me see, M Limited has the main. No, I should be able to pick really this from where? From that balance sheet. After that, remember, we don't own this thing 100%. We have another person here. This other person is called NCI. So give us the fair value of NCI at acquisition. Give us the fair value of NCI at acquisition, note number 3. Note number 3. Note number 3. Do we have note number 3? Note number 3. Note number 3. We are told H Limited has a policy of measuring the non-controlling interest at fair value. The non-controlling interest in S Limited was 970. 970. Thank you so much. 970. So if you add the two, then we shall be able to get the total consideration paid by all the parties. So the total consideration paid, can you kindly add these two for me? Could you kindly add these two for me? Could you kindly add these two for me? Could you kindly add 2,800? 2,800. So then once we get this total consideration, we shall come and less the net assets of S at acquisition. Is there somebody who can remind us what the net assets at acquisition were? Is there anybody who can remind us what the net assets of S at acquisition were? 2440, right? 2440, like that. So please subtract. So 2,800 minus 2,440, this will give us what figure? 2,800 minus 2,440, this will give us what figure, somebody here? This will give us what figure, somebody? They're telling me 360. 360. So this is goodwill at what here, somebody? At acquisition. Goodwill 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 at acquisition is 360. So I would want to do the next question, but because of time, I would want to drop this session right away there. But of course, the next part, which is basically net assets of L and the goodwill of L, because now we have said L is a subsidiary, you shall be able to check this out in my part 2 of this session. So it basically means that you must subscribe to my channel so that when I upload another video, you guys will be able to do what here to see. Great. And of course, as I sign out, we are RCM Online College and we don't believe in physical classes. They're not effective, right? We are 100% offering all our classes virtually. And the virtual classes are very effective because now I can easily call my students even at 4:30 through our WhatsApp platform, and they're able to attend this 4:30 a.m. class. I mean, it is the best thing that ever happened. And of course, like now these videos are being recorded, they can easily go and watch them later. The best thing really. And of course, the fact that we have all our students, or rather most of our students are spread out there, all over. So hii ndio wakati wa virtual classes and ziko juu. So that is it. If you would want to, ladies and gentlemen, talk to us, of course, we have our number here, 0719 525,000. And we are very modest in our fees. We charge Kenya shillings what here? 4,000. Otherwise, thank you very much. Keep on following us. Bye-bye.